India's 3 inflation indices latest news. The government released 3 inflation measures for June: the Consumer Price Index, CPI, Wholesale Price Index, WPI, and Producer Price Index, PPI. All 3 showed prices rising faster in June compared to May, driven by higher food inflation and elevated fuel prices due to weak rains and the West Asia war. However, a deeper look at the data reveals a more complex picture of subdued consumption, profit pressures, and India's growing dependence on China. The headline numbers. CPI inflation, relevant for households, rose to 4.38% in June from 3.93% in May. WPI inflation, year-on-year change in wholesale prices, increased to 9.87% from 9.68%. Output PPI inflation edged up to 9.57% from 9.38%. Notably, headline CPI crossed the RBI's 4% target for the first time in 17 months. Core inflation tells a different story. Despite the rise in headline CPI, core inflation remained unchanged at 3.9%. Core inflation measures price changes for items excluding food and fuel, both of which tend to be volatile and don't reflect changes in real consumption since households cannot easily cut back on eating or essential travel. The most widely used core inflation measure rose only 20 basis points over 6 months, from 3.7% in January. A narrower measure, excluding gold and silver jewelry as well, edged up to just 2.5%, sharply down from as high as 6% in early 2023. Economists interpret this subdued core inflation as a sign that consumption remains weak. Why has core inflation fallen despite strong growth? This presents a puzzle. Core inflation fell between 2023 and 2026 even as India recorded growth exceeding 7%. According to economists, the explanation lies in the nature of India's growth. Over the last 4 fiscal years, gross fixed capital formation, GFCF, growth, driven by investment, has consistently outpaced private consumption growth. This means the economy's productive capacity has expanded faster than actual consumer demand. Indicators like vehicle sales, and credit card and durable goods loans, point to moderating discretionary demand following the GST rate cuts of September 2025. The China factor, importing deflation. A major driver of India's narrow core inflation is falling prices of Chinese goods. China's Producer Price Index, PPI, has stayed in negative territory from October 2022 to February 2026, meaning India has effectively been importing deflation from China. India's goods imports from China now exceed $130 billion annually, representing close to 3.5% of India's GDP. India's increased supply chain dependence on China means price spillovers are becoming stronger. The GST rate cuts and their resulting price reductions have also kept core inflation subdued over the past year, though this low base effect will fade in the coming months. Dining out gets costlier. One segment of core inflation that has risen sharply is restaurant and cafe pricing. Restaurant and cafe inflation rose from 2.73% in February to 6.94% in June, driven by higher commercial LPG prices linked to the West Asia war. This reflects the second-round impact of LPG price hikes, though a recent cut in cylinder prices may moderate this trend going forward. Profit margin pressures in manufacturing. While restaurants have passed on rising costs to consumers, the manufacturing sector appears to have absorbed higher input costs instead, likely due to weak consumer demand. The manufacturing sector's output PPI declined 0.3% in June from May. Meanwhile, its input PPI, an experimental new metric, jumped 2.1% month-on-month in June. This gap indicates that manufacturers' selling prices remained largely stable even as their costs rose. More broadly, the all-commodity WPI rose 6.9% from February to June, while CPI rose just 2.3% in the same period, a significant divergence. Economists notes that price pressures in CPI remain relatively moderate despite rising input costs for producers, though the effects of May's Indian rupee 7.5/liter hike in petrol and diesel prices will likely be felt over the next 12 months. What this means for monetary policy. Inflation remains the cleanest indicator of the underlying strength of consumption. The current data suggests that consumption still requires support from monetary policy. With the India-US inflation differential near historical lows, analysts argue there remains room for a more accommodative interest rate environment in India. Conclusion. India's June inflation data paints a layered picture. Rising headline numbers mask subdued core inflation, weak consumption, and growing reliance on cheaper Chinese imports. With manufacturers absorbing cost pressures rather than passing them on, and consumption needing continued monetary support, policymakers face a delicate balancing act between growth, prices, and India's deepening trade dependence on China.
Thank you for watching. Helps you in your UPSC journey. Don't forget to subscribe to our channel for more guidance and click the bell icon to never miss an update. Keep studying hard and good luck.